Okay, good afternoon, everybody. As I said, my name is Tom Foster. I'll be your moderator for today's call. And I think this is a great time for all of us in this country to stop and really think about where we're going and how we can join together to overcome this crisis that we're now faced with. And I've got a great group of panelists today that are going to walk us through some of the provisions, both of the law and answer some questions in the stimulus package. So let me start by introducing our speakers. First of all, we have Chris Gaston. Chris is the Senior Policy Director of Davis & Harmon, LLP. Chris has more than a dozen years of Capitol Hill experience, and he represents clients on a wide range of issues before Congress, particularly retirement and savings policy. Prior to joining Davis & Harmon, LLP, Chris served as the Chief of Staff for U.S. Representative Rush Holt, a Democrat from New Jersey, who was a senior member of the House Committee on Education and Labor. Chris graduated from the George Washington University and received a master's degree from Georgetown University. He and his wife, Molly, have two active kids, Max and Claire, and one growing Labradoodle, Daisy. Michael Hadley practices in the area of employee benefits, advising clients on a full range of tax, ERISA, and other laws affecting benefit plans, particularly focused on 401k, 457, and 403b plans. Michael is a frequent speaker and author of the benefits and tax developments coming out of Washington, D.C., and has testified before the Treasury, IRS, and Department of Labor. He provides public policy assistance to trade organizations and financial institutions, and serves as outside counsel, relations counsel to Spark Institute. He serves as Davis & Harmon LLP's management committee, and in 2018 through 2019 as the firm's managing partner. He received his law degree from the University of Virginia, where he was the notes editor of the Virginia Law Review. Michael received his BA cum laude from the College of William and Mary. Next, we have Peg Knox. Peg is the Chief Operating Officer of the SEIA. Prior to joining the SEIA, she was the Global Retirement Plans Manager of Bechtel Global Corporation, where she worked to generate and implement new ideas for Bechtel retirement plans to enhance retirement security for its employees. Previously, she had served as Bechtel's treasurer, where she ensured efficient global treasury operations, including cash management and investment, debt, credit lines, foreign exchange services, and other treasury functions to support the company's business lines. Peg has an MBA from St. Mary's College and is based in San Francisco. And finally, we have Glenn Spencer. Glenn is the Senior Vice President of Employment Policy Division for the Chamber of Commerce, which represents the interest of the employer community across a range of labor and employment issues. The division works to ensure that laws and regulations affecting employers are developed with employer concerns, acknowledged, and fairly applied. It also provides businesses with guidance and expertise on legislative and regulatory matters. Before joining the Chamber in July 2007, Spencer spent nearly 6 years at the U.S. Department of Labor in the Office of the Secretary, and brings a long history. As a matter of fact, when he was in the Office of the Secretary, he was actually served as Deputy Chief of Staff and then Chief of Staff to the Secretary of Labor, Elaine L. Chao. Earlier in his career, Spencer was engaged in issue advocacy and grassroots lobbying for the citizens for a sound economy in Washington, D.C., and also worked as a senior analyst in the research departments of the National Republican Senatorial Committee and the Republican National Committee. Spencer's articles have been published in numerous leading newspapers, and he has appeared on national syndicated TV. So welcome to the panelists and welcome to all of you. Just a few logistics before we get started. We have received an inordinate amount of questions relative to those calls you've been so gracious to submit. We might not be able to get to all those questions, which I can assure you we will not. But hopefully, through the comments of our panelists today, many of those questions will be answered. I will have the opportunity of answering a couple of questions as we go along. And also, if we do not get to your specific question and it was not covered by our panelists, we'll give you some resources to look at the end of the call. Also, this call is being recorded. And for all of you who have registered, you will receive a copy of this tape recording soon after the program is over, but hopefully no later than Monday. Also, the sponsoring organizations will be posting them to their websites. So as we start off, let me first say, from my own perspective, I'm the managing director of TROW Speakers Bureau, the TROW Advisory University Speakers Bureau, and I've been in this industry for 40 years. I have never seen anything like this in my lifetime. First, the horrible COVID-19 virus. As of this morning, there are 85,968 confirmed cases with 1,268 deaths. Medical experts from all over the world, including our own Dr. Anthony Fauci, are collaborating to try to find a cure. This has caused a major trickling down effect in our economy. We looked at the unemployment numbers yesterday, and 3.3 million Americans are filing for unemployment. The market has suffered record losses, but in the last 3 days, it has rebounded in response to the predicted passage of the stimulus bill. The stimulus bill is being debated in the House as we speak. Among other things, the bill will provide the government to send direct payments to taxpayers depending on income. Unemployment benefits will grow substantially and go to more Americans. Small businesses will receive emergency loans if they keep their employees. Distressed companies will receive government bailouts, but with strings. Hospitals suffering as a result of the COVID-19 will receive aid. Another major concern of Americans participating in retirement plans and the stimulus package have an effect on their retirement plans. They want to know, how is this affecting the retirement plans? And is there any other legislation pending in Congress right now that could affect their retirement plans? So, Michael, I'm going to turn to you first. And I know Congress right now is working on legislation that includes provisions that impact retirement plans. Could you give us a quick overview of what's going on in Congress right now, Michael, as well as the stimulus package?
Sure, happy to. And thanks for having us. And I share your concern about everyone in the audience that you're safe and healthy. I know we have my colleague, Chris Gaston, who is literally watching what's going on in C-SPAN right now. And I look forward to hearing from him kind of the latest status on the bill that I'm about to talk about. But we do expect it'll pass at some point. The bill called the Coronavirus Act Relief and Economic Security, or CARES Act, contains a number of provisions that are aimed at helping those folks that have issues associated with COVID-19 and may need to access additional resources through their retirement plan. I'm going to go over them, at a fairly high level, and of course, we're happy to take questions, some of which we've already received. The provisions of the CARES Act that are relevant to retirement savings largely track things we've seen previously in connection with hurricanes and other natural disasters. So if you've ever had the opportunity to kind of help a plan through getting money to participants in connection with, say, a hurricane or wildfire, this will look familiar to you. High level. The first thing that the bill does is create a new type of distribution called the Coronavirus Related Distribution, or a CRD. So we have a new acronym. A CRD is a distribution of up to $100,000 that can come out of a plan or IRA. And the advantage of it is that the 10% penalty that might otherwise apply is waived. In addition, the individual is eligible to spread the income related to that CRD over 3 years. So if I take a distribution of $100,000 for my plan, I would pay $33,333 in gross income on my taxes this year, and then the same over the next 2 years. In addition, that payment that came out of the plan or IRA is allowed to be repaid within 3 years. Now, in order to be eligible to take a coronavirus-related distribution, the plan would have to allow it. You don't need to amend your plan immediately, but eventually you would. The plan has to make sure that it's available because it's optional. And the individual has to meet one of 3 criteria. They have to be diagnosed with the virus, they have to have a spouse or dependent who is, or they have to experience some sort of adverse financial consequence as a result of, for example, being home from work. And the participant is allowed to certify that they meet those criteria. That's the first relief in the bill. Second relief is that it would allow plans to increase the loans, the amount of a loan that somebody can take out of their plan if they're one of those qualified individuals. It increases the loan limits from $50,000 to $100,000 and from 50% of the account balance to 100% of the account balance. Again, that's an optional provision, and the plan would have to decide to adopt it. In addition, a loan repayment that is due between now and the end of the year, between enactment and the end of the year, can be delayed up to 1 year. So that's the loan relief and distribution provision. In addition, the bill includes a waiver of required minimum distributions for 2020. So an RMD is the distribution that plans that IRAs must make once somebody reaches 70.5 or now 72 because of the Secure Act. And the bill would waive the requirement to take an RMD in 2020, not just for somebody who's already taking RMDs, but also for somebody who turned 70 and a half last year and has to take their RMD by April 1. We saw something like this in the past with the financial crisis, where when there was a waiver of the 2009 RMDs because of the significant downturn in the market. And that's the reason for this. The thinking is, look, my RMD is based on last year's account balance, and most people's accounts are significantly diminished. And therefore, if you were forced to take an RMD now, you'd take out a lot more than intended by the percentage. I'll just mention a few other quick things. There is a delay in pension funding. So if your defined benefit plan has some sort of pension funding obligation this year, it would be delayed until January 1, 2021 with interest. And there's also some relief from the benefit restrictions that apply to defined benefit plans. And there are a few other provisions in there as well that are relevant, but those are the big ones. If you're on mute, Tom, we can't hear you.
I'm sorry. My question was, Michael, is if I already took my minimum distribution for 2020 because I was required to, would that have any effect? Would the bill have any effect on that?
So if you have an RMD due for 2020 and you already took it, then you would be that distribution that you took is sort of transformed into not an RMD. So it would be eligible to be rolled over back into your IRA. You don't have to do that, but it sort of turned into something other than RMD.
Now, what do plan sponsors need to know, Mike, if the plan doesn't currently allow for loans or withdrawals?
So both this new distribution right as well as this increased loan are optional provisions. Can you hear me?
Yes, I can hear you. Yeah, there was a little bit of breakup.
Okay, great.
We're fine now, and I think that's very important to stress, Michael, as you did in the beginning of your program, and that is it's very important that all the plan sponsors check with their plan documents to make sure that they're either allowing or not allowing for some of these things you've mentioned. Now, the IRS has extended the deadline for filing individual returns until July 15th. What have they said about the impact on retirement plan and IRA deadlines? And what other deadlines should plan sponsors be watching?
Great question. So yes, as everyone knows, the deadline to file your return has been moved to July 15th. The IRS has clarified that also extends the deadline to make an IRA contribution, right? Because you can make your IRA contribution for 2019 all the way until you file your return, and that deadline's been extended. Same is true for making an HSA contribution for 2019. The IRS has also clarified that the period to make your 2019 employer contribution, because there's a grace period, is also extended until July 15th, 2020. That's under Code Section 404A6 if you care for the code section. But it does not delay the period to remove excess deferrals. So at least until the IRS tells us otherwise, you have to get excess deferrals out of the plan by April 15th. We do expect there are other deadlines that are coming very quickly. So for example, there are a series of deadlines that apply throughout the code. Often those are extended automatically when there's a disaster, and we are expecting at some point IRS will give us some guidance on some of those deadlines. We know they are working on them, but we haven't heard more yet. So for example, if you are supposed to file a 5500, normally that gets extended in connection with disaster, and we expect, I'd be very surprised if there wasn't an extension for 5500 that's due very soon. We just haven't heard yet. We know they're working flat out.
Now, speaking of extensions, Mike, one of the questions from the audience is there any update on the 331 plan restatement deadline and any possible extensions?
Yes. So if you have a 403B plan, we finally have now an end date for restatements. We've been waiting forever, and it's that restatement deadline is 331. The IRS has been asked by multiple folks for an extension of that. I just worked on a letter that was sent yesterday for a client that asked for an extension. Another example is defined benefit plans that use a pre-approved plan document. Those need to be restated by April 30th. Both of those deadlines, are coming up incredibly fast. And there has been no extension as of yet, but we know that the IRS is aware of that deadline, and I'm hopeful they'll get around to it. I will say that, I think the IRS is going to be very reasonable. So if you've got a client that has not yet updated their 403B plan or their defined benefit plan per these deadlines, and just because nobody's in the office, you cannot get that physical signature, get it signed as quickly as you can. And my guess is that the IRS is going to be very generous in terms of providing relief. They are not going to disqualify a 403B plan just because you didn't get it signed by the 30th. We are pushing the IRS to give us an extension as soon as they can.
That's great. Thank you very much, Michael. Now we'll move on to Glenn. Now, Glenn, in doing some research relative to the chamber, I saw something about a driving principle that you're currently using during this crisis. And it states that we believe no business or family should go bankrupt because of this crisis. The U.S. Chamber is committed to providing every business and worker the help they need. Now, as you look at this, Glenn, you look at what you're doing at the chamber, what are some of the resources that are available to the members currently and in the future?
Well, thank you for the question and for noting our principle on this. I think you summed it up correctly. We think that no business that was a functioning, going concern before this emergency hit should go bankrupt because of this, and no individual who was financially self-sufficient should go broke because of this crisis either. This is not something that anyone would have anticipated, but it's something we think that together we will get through. If you go to the U.S. Chamber webpage, right on the front page, there are a number of resources available, things that businesses can do just on a practical level to keep employees safe, things that clarify what is in some of the massive relief bills that have passed. We've been fielding a lot of questions from our members trying to get clarity around some of those specific provisions. And it's a little bit tricky for us. We're all sort of learning as we go because, needless to say, this is not the way Congress normally passes legislation. 1,000-page relief bills that spend $2 trillion usually don't get through in a couple of days. There's usually a lot of report language and other things you can turn to answer some of those questions, but we are all learning on the fly and trying to provide as much information to our members as we can about how these specific provisions will impact them, their businesses, and their employees.
That's great. Thanks, Glenn. Now, as you know, there's several phases to this bill. In phase 2, the relief bill includes a new paid leave provision. How is this different from the current law and who is covered, Glenn?
Yep. So the phase 2 bill has really 3 streams of income for employees to think about. One of those is the UI system, and there's some beefed up UI benefits in the phase 2 bill, and then even more in the phase 3 bill, which we can talk about in a bit. But the key provisions in the phase 2 bill are paid sick leave and paid FMLA leave. As I'm sure everybody on the call knows, there is no mandated paid sick leave provision under current law, so that's completely different. And there's no paid FMLA leave provision under current law either, so again, quite different. So let's take the paid sick leave provisions first. The key numbers to remember here are 50 and 500. If you are an employer with more than 500 employees, that's more than 500 employees, this does not apply to you. It only covers employers who are 500 and below. And the reason for that is because policymakers assume that if you're a business with more than 500 employees, you are probably already providing leave to your employees of some kind or another. If you are below 50 employees, the Department of Labor is going to issue regulations under which you may be exempt from the paid sick leave provisions because it would pose a threat to the viability of your business. So for those who are in that middle area, what the bill says is that employees are guaranteed 80 hours, that's basically 2 weeks if you work full time, of paid sick leave, and that can be taken for a number of reasons. If you've been given a quarantine order by a government official, if you've been told by a healthcare provider that you need to self-quarantine, if you're experiencing symptoms and you go seek medical diagnosis, all of those are covered. If you're caring for an individual who's subject to a quarantine order, if you're caring for your kids because schools are closed, those also will qualify you for the paid sick leave. The rate for that paid sick leave is capped, so it's not whatever you've been paying somebody before they get while they're on sick leave. There are benefit caps. So the paid sick leave is not to exceed $511 per day or $5,110 in the aggregate. So that is the maximum amount. However, there's a lower amount as well. If you are taking the sick leave because you need to take care of your kid because school is closed, or you're taking care of somebody else who's been quarantined, then the maximum amount is $200 per day and $2,000 in the aggregate. Two important qualifiers for all that. One is this is available only if you are unable to telework. If you can work remotely, this sick leave does not apply. Second thing to note is that, well, we already talked about the 50 employee exemption. That is not necessarily a guarantee. That is going to be determined by the regulations. This leave is also on top of whatever else you offer. So if you already offer employees paid sick leave, you can't force them to take that sick leave in exchange for this. This 80 hours of paid sick leave is on top of whatever you might already offer, or what your state or local government may require. Some states and localities do have their own paid sick leave requirements. This is on top of that. The paid family leave provisions are a little bit similar. Someone can take paid family leave for up to 12 weeks. The first 2 weeks of that are unpaid. The subsequent 10 weeks would be paid. There are benefit maximums for that too. So the individual can receive up to $200 per day for that paid FMLA leave, but not to exceed a maximum of $10,000. That's the maximum that they can get paid during that time. But the eligibility requirements are a little bit different than under the paid sick leave. Under the paid family leave provisions, you can only take that FMLA leave to care for your child if school is closed or their regular daycare provider is unavailable. But again, this leave is on top of whatever other leave that you might offer. There's additional stuff in the Phase 3 bill that limit this a little bit, and then talk about how an eligible employee can be someone who you may have furloughed or laid off. If you bring them back during the course of this emergency, they then become eligible for the leave. Now, the key question we get with all of this is, how are we as employers supposed to afford this if we're under that $500 employee threshold? And the way that the government is going to deal with that is they will provide tax credits to compensate you for the full amount that you spend under this provision. Many people have commented that smaller businesses can't wait till the end of the quarter to get that tax credit. The Treasury Department knows this. What they have essentially said is all of the money that you would set aside for paying payroll taxes, just keep it. You can apply it to this benefit. At the end of the quarter, we'll settle up and see if you owe anything or if we owe you more. That's how they will deal with that liquidity question. So why don't I stop there for now and see what other questions you have.
Yeah, you mentioned the Phase 3 of the bill, Glenn. Now that includes an expansion of the unemployment insurance system. How broad are these expansions, Glenn?
Right, they're pretty broad. So as you know, UI is a split between the state and federal government. States really handle the bulk of the load when it comes to regular UI payments. What this bill does is a couple of things. Number one, it extends the benefit period. Some states are as low as 20 weeks, some are 26 weeks. It varies all over the map. This bill says, okay, you're going to get an extra 13 weeks of extended benefits no matter what. And instead of that being a 50-50 split between the states and the feds, the federal government will pick up the whole cost. The bill also says that the 1 week waiting period, which is typical under UI, should be waived, and the federal government will pick up the cost for waiving that 1 week waiting period so you can get your UI benefits right away. The bill also opens up the type of workers who can get UI. Under traditional UI, self-employed and independent contractors are not typically going to be eligible for coverage. This bill allows those individuals to access the UI system for specific corona-related issues. Essentially, anyone who is unable to tap into regular UI benefits is going to be caught up in that catch-all that they're calling pandemic unemployment assistance. So anyone who needs to access the UI system should be able to. In addition to that, the bill tops up the amounts that people can collect for UI. States are all over the map in terms of what the average weekly benefit is. But what this bill says is, regardless of your average weekly benefit, we're going to give everybody another $600 per week in UI benefits. And that additional $600 will extend for 4 months. So July 31st is the date that expires. One last provision, the bill talks about short-time compensation. That essentially means if you don't have a lot of work at your facility, you're going to send somebody, you're going to cut somebody's hours to 20 hours a week instead of 40. There's a special short-time compensation provision in the bill that allows you to continue paying that employee, but you'll split the cost with the state unemployment agency. So you wouldn't be paying them their full salary or wages for that 20 hours. You'd be paying them the reduced amount, but the state would help pick up that cost. There's a number of states that already have that type of short-time compensation at law. For those who don't, what this Phase 3 bill says is you don't need to call your state legislature back to pass a new bill. All you'll do is sign an agreement with the Secretary of Labor, and he will start providing that type of compensation through the state. So a number of provisions that expand that UI safety net.
That's great. Well, thank you very much, Glenn, and thank you for all the work the Chamber is doing and keeping your members informed during this time of crisis. Now, speaking of crisis and speaking of the stimulus bill, let's go to you, Chris. Now, Chris, we had assumed by the time this call was started that we might have already had the bill passed, and at least by the end of today. But as of this morning, I understand we have a holdout. One congressman is holding out. And so my question for you, Chris, is you've been following this on TV as we're speaking. Is he still holding out? And what is the issue that the congressman is holding out because of? And how would this affect, the second question is, how would this affect the process? And then third, how long could this possibly tie up the inevitable? I mean, this bill is going to pass one way or another, but how long could this delay it?
Yeah,
like
that's a great question, and I'll answer it. Yeah, I'll answer it quickly. The bill just passed. They steamrolled him.
Oh, great.
So Tom Massey of Kentucky had been objecting to a process that the House leaders had specified they'd be using to pass the bill by voice vote, under the view that the legislation should kind of get a recorded vote, which is kind of, if you're a C-SPAN junkie like me, I know there's a big cohort of you out there. You watch that screen and, votes go in one column or the other column. I'm joined by my Labradoodle right now. She's very excited about this voting process as well.
She's excited the bill passed.
And yeah, she's very excited. And the reality is that that's how most bills pass, but sometimes they do pass by unanimous consent or voice vote. In this instance, Massey, because of the size of the package, because of his particular love of the Constitution, I don't know, he just read a book, How to Lose Influence and Make Enemies. He wanted to put members on the floor and have them vote. And ultimately, it appears that House leaders were able to get the 216 House members they needed to establish a quorum to the floor, and they were able to overrule his objection. I'm actually very surprised. I think they were, very nervous and touch and go for the last kind of couple of hours, trying to make sure that they actually had the number there. If they hadn't, it would have delayed, as you said, the inevitable. But the good news is the bill is passed, and I'm watching a video of House members walking down those august marble stairs, leaving the Capitol, hoping not to return to Washington until late April.
And weren't a lot of the congressmen scurrying to get back to get that quorum, Chris?
I think he, as I said, and maybe jokingly, but seriously, this is not very popular. I think a lot of members would have preferred not to come back to Washington. If you look at any of the CDC guidelines, members of Congress who tend to be a little bit older, who tend to gather in large groups with lots of people, are kind of a human petri dish for coronavirus. Obviously, at least 2 House members have tested positive, and 1 senator. And as Mike mentioned, right, the package that the House just passed cleared the Senate 96-0 on just a touch before midnight on Wednesday night. Why wasn't it 100-0? Well, 4 senators one of whom, Rand Paul, also of Kentucky, actually has tested positive for COVID-19. Two senators had lunch with him the day he tested positive, or the day before. They're self-quarantining. Another one was feeling not well, doesn't think he had COVID-19, but wanted to err on the side of caution. But, that vote was essentially 100 to 1. And, I think what the House just did was show that they also had the same unanimous view that this legislation needed to be approved.
Right. So I guess like your Labradoodle, he was barking up the wrong tree. No pun intended. Now, Chris, now that this bill has passed, what response do you see next?
Yeah,
and will Congress take any additional action?
Yeah, I think already before, the bill has been passed, there's a formal process now that they have to engross the bill. They put it together. The Speaker signs it. The Senate pro temp signs it. And then the bill goes to the White House for the President to sign it. That process will be probably as expedited as humanly possible, given the parameters of an 883-page bill. It is important that all the pages are there, that all the provisions that were in the past bills are there. There have been occasional mistakes with that. So they want to get it done as fast as they can, but they want to make sure they have everything there. Then the president will sign it. But even already this week, after the Senate passage, a number of members are talking about, well, what's phase 4 going to be? And I think there is a lot of interest. There's certainly discussions among Ways and Means tax writers on the House side and folks on the Senate side about what provisions should and shouldn't be in there. You just had Speaker Pelosi close out the floor debate by saying, people have asked me about this provision or that provision, and I said it can't be in this bill because it's not about COVID-19. It might be about economic recovery of an industry or something like that, but it's not about the healthcare crisis pressing. And she's clearly indicating that she's looking forward to a fourth package. I think the parameters on that are maybe a little bit more expansive than this package. But I also think, the reality is this package is not understood well. No one, and this, is just always true, really could have read through the 883 pages and understood it well. A bill is not a novel, not a great work of literature. It's technical. It requires cross-reference knowledge and other underlying statute knowledge. And, I think the reality, too, is there's this kind of $500 billion fund at Treasury. A little bit TBD on how that money is going to be spent. Those of us who lived through the Great Recession will remember the TARP program, which, put money Congress approved to help rescue the economy. It's really important to remember what TARP stood for, Troubled Asset Relief Program. And the TARP program never purchased a troubled asset. The money was used for other things, meritorious and successful. But I raise that as a point to say, even what members of Congress think they did today, they might need to, A, do more in a fourth package, or B, circle back to figure out how to fix it. And the authorities they've granted might be used in ways that they don't fully anticipate, for good or for bad. This is going to be a fast developing crisis. Congress is not normally a fast moving institution. This $2 trillion package materialized in 8 days. From last Thursday with the first draft to, this afternoon, it's going to get signed into law. That is not lightning fast. That's faster than Usain Bolt times 3. So, there are going to be mistakes here, and they're going to have to correct some of those mistakes and also address for continuing issues going forward.
And so we are to assume that President Trump will sign this bill by the end of the day today. Is that correct, Chris?
Yes. I don't know. That is the expectation. I think the market expectation, the congressional expectation, and I think he'll sign it as soon as it gets to his desk. He's indicated he would. He publicly, if you're looking for a little lighthearted humor, there's an exchange between @RealDonaldTrump on Twitter and @John Kerry, where both of them agree that Tom Massey is not their best friend right now. He's going to sign it, and I would expect that to be today. But every day we're taking every day.
As we look back over these last several weeks, Chris, do you see the Congress taking action to modify how it operates to respond to this public health crisis?
It's a great question. I think while all of us in the private sector had contingency plans and work from home plans, and some of us even kind of regularly work from home or work remotely, that is not how Congress operates. Congress is a face-to-face, people-to-people business. Members of Congress are people. They like interacting with people. They do their business in person. For those of you out there, that large contingent who are C-SPAN junkies, during a vote in Congress, it's an interesting dynamic. Yes, they're voting on the underlying legislation. They're putting a card in, and incidentally, it's actually kind of one of the reasons that they are thinking about looking at their systems, because there are lots of responsibilities that members of Congress have that they can devolve to their staff, but one of the only responsibilities that they alone can do is to vote. That's good. We elected them, and they're the ones who should be voting. But if they are sick, if they are, a daughter's graduation, or if there's a public health crisis like that, it does challenge that structure. So there is a discussion among some members of Congress maybe to look at remote voting. I know some state legislatures have already explored that. I think, at least initially, there's a lot of pushback from members of Congress who are more senior, who are more institutionalized focused, that it does change the institution. And, I'd say currently, subject to change, I'm kind of in that boat because, when you look at that C-SPAN vote screen, yes, those members of Congress came down to vote on, whether we should name the post office after Sergeant Miller or Fred Rogers or any other number of measures they're voting on. But that's the time they get to talk to their colleagues. That's when they get to not only catch up socially, but also engage in legislative business. Hey, could you support my bill? Could you support my amendment? We need help on this. I need funding for that. It's how Congress operates. And very much like, the disappearance of business meetings that you're all facing over the last few weeks, it does make business harder when you're doing it via Zoom. Anecdotally, though, my 7-year-old and 10-year-old seem far more adept at Zoom than I am. I'm trying to take daily lessons from them.
That's great. And I think, talking about the social interaction, I think we've seen that manifest itself over in England, or Prince Charles yesterday, and then, of course, Boris Johnson today. And how do you carry on government with those types of interactions that you can't have them, and then you have to do it remotely? So it's a challenge. It's not only a challenge here in the U.S., but also worldwide. Well, Chris, thank you so much for your comments. Really appreciate your insight. I'm very happy that we're able to get that up-to-date news that the bill has passed, and we can move on from there and hopefully just come to a very meaningful conclusion for all Americans. And next person I'd like to turn to is Peg. And Peg, you come to this with a rather unique experience. You first of all were a plan sponsor yourself at Bechtel, and now you're leading a great organization in DCIA, which is the Defined Contribution Institutional Investment Association. And this time of crisis, Peg, and you've got right now I think over 185 member organizations. What are you hearing from your members and hearing from plan sponsors during this time?
Sure, thanks, Tom. We're hearing a lot. First and foremost, I would say the priorities of companies large and small are completely focused on the impact of the pandemic on their overall business and their employees. They're more focused on how do we keep our employees on the payroll? How is remote working going to work? Will our technology keep up? How are we going to help our employees stay financially secure? Frankly, retirement adequacy of their employees is not top of mind as they work their way through these issues. Specifically related to the defined contribution plan, we're hearing that some companies of all sizes are considering whether they can freeze or postpone their company matching contributions. As I said, their priority is to keep people employed, and company contributions can be a needed source of cash for them. We've seen more small plans work towards this versus large ones, but large ones are considering it as well. On the investment side of defined contribution plans, plan sponsors are expressing similar concern as they did in 2008. It's not so much about the market volatility and performance, it's more, will the money market fund break the buck? How will the stable value fund perform? Is there going to be any impact on our security lending programs? We're also hearing, for the most part, that any plan changes that were not already underway have been postponed indefinitely. Finance and HR departments that work on those plan changes are really focused in other areas, flex time, leave of absences, sick pay, healthcare, not on DC plan changes or any retirement plan changes. As it relates to the DC plan, we're seeing plan sponsors considering removing wait periods for loans or adding loans if they don't have that feature, as well as ensuring in-service withdrawal and hardship withdrawals are available. We're seeing some increased participant activity in these areas already. Plan sponsors and their record keepers are communicating to participants about the market volatility, reminding them to be a long-term investor and stay diversified. Also, plan sponsors are reminding participants in target date funds and managed accounts that their accounts are being managed by professionals. I think a key message right now to participants should be to pick up the phone and have a conversation with someone at the record keeper or an advice provider before making any rash changes. Record keepers are seeing increased call volumes from participants looking for some advice on what to do with their investments. And they'll continue to see increased call volumes as people call in for loans and withdrawals. Going back to the DC plan not being top of mind for plan sponsors, it's not for a lot of participants either. I mean, you can see anybody who's losing their job isn't necessarily worrying about their retirement security. All the frontline healthcare workers are, pushing 48-hour shifts, and they're not concerned at all about their retirement plan at the moment. It's too soon to have good data, but anecdotally, we're not seeing a large movement in investments yet, beating participant changes in investments. Initial data is telling us that those participants in professionally managed investments like target date funds or managed accounts are sticking with it more than participants who self-direct their own investments. On average of those moving, you can imagine would move into stable value, money market fund, or fixed income. But today, like 2008, brings to the forefront the need for more holistic advice, especially for those near or in retirement. As we all know, this cohort is the most vulnerable in market declines, and plans to offer advice can be helpful in keeping this group on track. And finally, in our recent discussions with plan sponsors and DCIA members, financial wellness keeps coming up. Financial wellness benefits are now even more important in order to help employees weather what is happening to them personally, their reduced income, loss of employment, health issues, child support. It can go on and on. So that's a very important aspect right now.
Okay. Well, I have a couple questions from the audience, Peg. First of all, I think you mentioned this in passing. Are DC plan sponsors considering any investment changes or additions to their investment lineups because of COVID-19, this crisis?
Yeah, it's probably a bit early to determine if the crisis and the volatile markets will result in investment lineup changes. As noted before, plan sponsors aren't making any changes to the plan right now other than those that they were already working on. I think at a minimum, plan sponsors with their consultants or advisors will probably complete a thorough review of their investment lineup after we kind of get through the initial part of this crisis to determine if there's any other asset classes they should add. And I would also imagine that plan sponsors that don't offer participant advice today may more strongly consider it in the future.
Great. Another question is, messages today are designed to help participants deal with panic, market volatility, and why not move funds to less risky funds? What are your thoughts about that, Peg?
Yeah, so DCIA has a plan sponsor steering committee. It's made up of large plan sponsors, and we surveyed them earlier this week about what messages they're communicating to participants, and it is to try to help them deal with panic around the market volatility. First, the prevalent messages were around being a long-term investor, a reminder of resources available to them through the record keeper and the company's employee assistant programs. They're reminding them of the merits of being diversified. And for those in target date funds and managed accounts, they're reminding participants that their investments are managed by professionals. As far as moving into less risky funds, I've also seen from many of the DCIA member firms messages about how missing the best performing days in a market can impact your account balance. It's amazing how just missing the top 10 days can really impact your retirement savings.
Yeah, in researching your organization, Peg, I saw some guiding principles, and they are retirement adequacy, best practices and plan design, institutional approaches, choice, transparency, and fees. And we've got 180 member organization, 885 members strong. And how are the DCA members helping plan sponsors today?
Yeah, sure. DCA is really a collegial, collaborative environment, and I think, as we work our way through this crisis, you'll see our members pull together as they always do. But to some specific member types, record keepers, as you would expect, are playing a huge role in these uncertain times, both for participants and plan sponsors. They've been implementing their business continuity plans to ensure they can adequately handle the increased call volume from participants. They're providing questions and answers for plan sponsors so that their clients know what steps record keepers are taking to service them and their participants. They're also providing the necessary participant communication, not only through the call centers, but by messaging on their websites, on their mobile apps, as well as on social media. And I think a key point is, and the record keepers obviously know this, is that as time goes by, plan sponsors will be asking the record keepers to provide data on the participant activities during this time so that they can report to their fiduciary committees and make any plan design changes or provide relevant participant communications that are data-based. Other cohorts of members that we have consultants in the advisor community play a big role as well. Some are setting up COVID-19 microsites with advice on what to do, not only in the retirement plan space, but all across the health and welfare space. They're supporting plan sponsors in all aspects to deal with various components of the crisis. Investment managers are getting a lot of queries from plan sponsors. As I mentioned, they're getting queries about money market funds, stable value, security lending programs, as well as general concern related to market volatility. And they're seeing significantly higher participation in their fund update calls. Investment managers are providing a lot of really good content to share with plan sponsors to keep them informed and to help them communicate calming messages to their participants. Some other member type firms, law firms, you can imagine, are getting busy reviewing plan documents for plan changes on the company match or distribution options. And ERISA counsel will also be helpful to plan sponsors in analyzing this stimulus package that was just passed. And I think financial wellness companies have a big role to play in today's environment. And so, I'm sure we'll see a lot more activity in that space. I did want to mention, Tom, that DCA has implemented a COVID-19 website. It's open to all. It's outside our firewall, and you can access it, and it has links to numerous members' COVID-19 resources that will be helpful to plan sponsors and, in fact, to a lot of people, everybody. And if you are a member and you're on the call and you have resources that are helpful, please send us a link to digital@dcia.org, and we'll get your link posted as well. So finally, DCIA, our members and our partners, Spark and the Plan Sponsor University, the Retirement Advisor University, are banding together to hold webinars like this one to help educate our members and plan sponsors. And DCIA will continue to push out our own thought leadership during this time to help all members of the DC community. And finally, I just wanted to recognize, Tom, one thing that our members and many of the plan sponsor firms are generously donating cash and medical supplies and even matching employee donations as we all work through to fight this virus. It is humbling and amazing how our community steps up in this time of need. So I just wanted to thank all the firms that have been participating in that.
Great. Well, thank you very much for your insight, Peg. I think it was very helpful for the plan sponsors and people on the call today. As a matter of fact, you mentioned keeping people informed as to what's going on during this crisis and beyond. You mentioned TROW and TPSU, the Plan Sponsor University. We're going to continue to do our Friday meetings, our virtual town meetings. And as a matter of fact, next week, we'll have an open town hall that's going to leverage a lot of the information that we're covering today with questions and surveys led by a panel of advisors, plan sponsors, and a lot of other people who can add insight into what's going on during this time of crisis. So advisors, plan sponsors, and providers, a good insight coming. So keep your eyes and ears open. You can go to our TPSU website, which will be referenced in just a moment. But as we end this call, first of all, I think we have time for one more question. And when I look at the audience, there's a lot of calls. I'll go to you, Mike. There's a lot of calls around safe harbor. And so talk to me about the impact of safe harbor contributions.
God, that's a great one. Yeah, I'm hearing a lot on that. So, safe harbor contributions are viewed as sort of mandatory. If you're a safe harbor plan, you got to make your employer matching or non-elective. That's a requirement. There is a provision in the regulations allowing an employer to stop making them, but there are some procedural requirements that might be difficult to meet. For example, you've got to give employees 30-day notice that you're reducing or eliminating your employer contributions. And the fact is, it's hard to give people 30 days notice, hard to give them notice, and then hard to give them 30 days notice. So there is a request into IRS and Treasury. The Spark Institute, as part of a number of things we've been asking for, has asked for relief from that 30-day notice requirement, as well as anything else the IRS and Treasury could do to help out employers that might be unable to make their safe harbor contributions. It's generally a small plan issue, and it's the small employers who are most likely to be unable to kind of make payroll. They don't have access to loans, and they may not even be open. Another possibility is to allow a delay in the amount of time that an employer has to actually make their safe harbor contributions, maybe push it off without having some sort of a failure. I would say to a plan sponsor that is as Peg said, is trying to decide, am I going to pay my employees? With respect to employer contributions, make sure people have health and that they can pay their rent. And there are ways to correct errors that are made under the IRS's program. And as we get through this, there are going to be probably plenty of resources, I'm sure, to help you clean all that stuff up. The only thing I would say not to do, do not use payroll withdrawals in the employee's own contributions. Don't use that to fund operations. That needs to go into the trust. And if you don't do that, that's a prohibited transaction. It's very serious. If there's a slight delay in getting payroll over, that's okay. I would just caution folks that the one thing the Department of Labor does not take kindly to is withholding from somebody's pay and then not sending it to the plan.
Well, there's one last question we get in here, Mike, and I think this is important. The audience question asks, will there be exceptions to partial plan terminations requiring 100% vesting when employer must lay off employees?
Oh, that's a great question. Yeah, so for folks who don't know what that question is asking, there's a rule that says that if you're operating a plan and a significant portion of the workforce covered by that plan loses their job, that's called a partial plan termination. And what happens is it triggers vesting. And the percentage that has to lose their job or be laid off is not a set percentage. There's a whole bunch of IRS guidance, and somebody's thinking ahead. Gee, I may have to lay off a significant portion of my workforce. Does that trigger vesting? At this point, I've seen no efforts to provide any relief from that. And in fact, my guess would be, just speculation, that the IRS would say, hey, this is exactly the circumstance in which a partial plan termination should occur, and exactly the circumstance under which we want to have vesting of plan balances. It's a good issue to watch out for. There are a whole series of issues when you have significant layoffs, including the WARN Act and other things, COBRA. And this is one of the ones worth keeping in mind. It's possible there'll be some relief, but I guess I wouldn't hold your breath.
Well, like I said, Mike, I wish we had time for more questions, but we don't. We're coming to the end of this broadcast. But as I said, hopefully some of your questions that you've asked have already been answered by the comments made by our panelists today. Also, if we can show actually show the resources that will be available on the next slide, I would suggest you take a look at these. And these are the resources available. And what I want to do is, there you see the resources. I would like to thank the panelists, Michael, Glenn, Peg, and Chris. I'd also like to thank the participating organizations for today's call. First of all, Davis and Harmon, TROW, the Retirement University, and TPSU, the plan sponsor university, the U.S. Chamber of Commerce, Spark, the Society of Professional Asset Managers and Record Keepers, and of course the SIA, the Defined Contribution Institutional Investment Association, and all of you for participating in today's call. This is a time for all of us to join together, share ideas and resources, and get beyond this crisis. It will pass, and we will get back to life as normal. I can only hope that all of you stay in good health and stay safe. And again, we look forward to talking in upcoming town halls, and we do have one coming up again next week. So thank you very much for your participation. I appreciate your time. I appreciate all the panelists and the participate organizations, and we look forward to talking to you again in the very near future. Thank you very much, and have a nice day.